Good morning, everyone. This is Bill Passarotti, a partner from Palmer & Kay in our New Jersey office. I now have 11 o'clock, top of the hour. We are still expecting a few more attendees to join us. However, the majority have already logged in. So again, good morning. This is Bill Passarotti. I appreciate you all attending our webinar today on navigating executive risk in uncertain times. 2020 has certainly been every bit of that. Uncertain times, difficult times, and challenges. But as we've always done in the past in the United States, we are resilient and we rise above. From some of the devastating economic and human tolls that COVID-19 has placed to protests and riots, and most recently natural disasters like wildfires and hurricanes. First and foremost, on behalf of Palmer & Kay and our friends at Arc South, our thoughts and prayers go out to all of our community and friends that have been impacted. Palmer & Kay is an insurance broker and advisor, providing strategic counsel to our clients in both the property and casualty and employee benefit space. It is through thought leadership, such as the content of this webinar, as well as transparent and timely communication, that we bring value to our clients day in and day out. Today, I have the pleasure of introducing our strategic partners and friends from ARC. Since 1986, ARC has been helping middle market businesses by providing executive liability and professional liability, brokerage, advisory, and services. I'm especially pleased with the team that we have joining us today. From Brock Bannister, a broker at ARC. Brock has been in the insurance space for over 13 years. Todd Horowitz, managing director and broker for ARC as well, has over 25 years in the business. Last but not least, Heather Fox, general counsel, has been with ARC and previously AIG and in the insurance space for over 24 years. The individuals on this call are truly foremost leaders and experts in their field. And without anything further, I'm going to turn it over to Brock, and we appreciate your time today.
Thank you, Bill, and good morning to everyone. One clarifying point I'll make on Bill's last comments, I would actually characterize Heather as most importantly. She's the one that keeps us all in line over here. So appreciate everyone's time this morning and, for the time for all the panelists. So, going through this presentation, this is meant to be a discussion. You're going to hear from the panelists as we go through. There is a question function in this software such that if you have a question for the panelists, please do submit that question as we go through. We will attempt to address that question while we are on that particular subject matter. If we don't get to it, we will make sure to address it prior to the end of the presentation. So as far as the discussion topics this morning, we're going to just give a brief overview of executive risk. Many of you on this phone call are very familiar with it, but there is a lot of different nomenclature out there, so we're just going to clarify what falls into that umbrella of insurance products and then what we're going to be talking about today. We're going to address the executive risk marketplace, which is very interesting in today's world. We're going to obviously discuss the elephant in the room, which is the impact of COVID-19 and how that has impacted executive risk. We will talk about some select coverage considerations, things that if you've got a copy of your policy sitting in the drawer, perhaps you pull out and thumb through, just food for thought. We're going to give some claims examples and talk about the trends going on in the executive risk marketplace. Finally, we are going to also talk about things that you can do to best position yourself for that upcoming renewal of your executive risk insurance. And then finally, we'll have the Q&A session at the end. So, going to executive risk. Executive risk has a lot of different names. Some people refer to it as executive liability, as financial lines, as management liability. So everybody uses a little bit different title. The way that we consider executive risk is the products you see before you. The purpose of this call is going to primarily focus on directors and officers liability and employment practices liability. Now, that's not to say that any of the other products such as cyber, professional liability, fiduciary, crime, or kidnap and ransom aren't important. We just don't have enough time. So we're going to focus on the D&O and the EPL today. And, obviously we can address any questions from any of you on any of these topics, but our topics for this discussion will be focused on D&O and EPL. As far as D&O goes, as a quick refresher, D&O essentially has two forms of protection that it provides. The first is personal asset protection. So in the event as a director, an officer, or anyone else that falls within the definition of insured person, if a claim is brought against you and you are not indemnified by the company that you work for, such that your options are reaching into your pocket or looking to insurance, that personal asset protection comes in the form of paying your loss $1. So there's no retention. And that is your personal asset protection. It's protecting your personal assets from loss. The other form of protection that the policy provides is corporate asset protection. That comes in two forms. The first is reimbursing the company in the event that it does have an obligation or it does have the ability to indemnify you in the event of a claim. The other form of that is in the event of a claim against the company itself, the policy would pay loss on behalf of the company. With respect to the corporate asset protection piece, there is a retention, also known as a deductible to many of you, for those two types of protection. So personal asset has no retention, corporate asset does. The other topic here on employment practices, there's basically two main types of employment practices claims. First-party claims, which are claims brought by employees or applicants for employment, and then third-party claims, which is generally a claim brought by any person that is not an employee or an applicant for employment. As far as first-party claims goes, the difference between D&O and EPL in this regard is D&O starts out as a very broad policy, and then it is reined in by exclusions, whereas employment practices insurance is actually what is commonly referred to more as a named perils policy. It has a very specific list of the type of allegations, types of causes of action that are covered by the policy. So it's a little bit more specific and therefore, a little bit finite in terms of coverage, and it's, certainly important to get that list right. So again, as we move through this presentation, any other questions that you have on any of these other lines of coverage, we're happy to address, but we're going to dig into the D&O and the EPL as we move forward. Now, as far as the marketplace goes, I'm sure it's no surprise to most of you, if you've been through an insurance renewal over the last 12 months, that things are changing. Things are changing primarily because premiums have remained relatively stagnant prior to the last 18 months. There's been some fluctuation depending on the industry you're in or specifics about your business, but for the most part, premiums have not kept up with the claims frequency and the claims severity. And the insurance marketplace, as it often does, will go through a period of pro-insured or a very competitive period where rates are depressed, and then immediately, almost a 90-degree turn, begin to harden quickly. And we are currently, I would say in the middle of that hard market. We're certainly not near the end, but we are far away from the beginning at this point. And some of the aspects of the hard market, or one of the main aspects of a hard market, is that there is simply less competition amongst carriers. Some carriers are not taking on new accounts, or they're being very selective. And part of that reason is that they are able to support their objectives in terms of growth, et cetera, simply by increasing the premium on their existing book of business, on their existing accounts. So there's less incentive to go out and take on new risks. In addition to that, which is no surprise to anyone on the phone, it's a very difficult environment right now. And new risks do carry with them some uncertainty. There is a period of getting to know one another between the underwriter and a new client. And in this environment, you can imagine that many people are being very conservative with regard to that. We've put some statistics here. These are our personal experiences. These numbers and rates are going to fluctuate depending on the different people that you talk to, because everyone has different clients, everyone has different experiences, et cetera. But in general, for private companies, we are seeing rates starting on a renewal basis at about 15% higher than what you paid last year. In addition to that, retention levels, or again, deductible, is oftentimes increasing by 50% or more. Now, depending on the size company that you have, depending on your existing insurance program, 15% could be a little bit of money or it could be a lot. Same thing goes with the retention. And keep in mind that the numbers sitting in front of you assume that there have been no material changes to your business. For businesses that have been, greater impacted by COVID, such as businesses that are dependent on tourism, et cetera, chances are that those businesses are seeing greater changes than those sitting in front of you. In addition to the changes that we're seeing on pricing and retention and just a lack of competition in the market, the scope of coverage, which has generally grown over that period of pro-insured time in the industry, or in other words, prior to the last 18 months, we're now starting to see that scope of coverage that was once expanded begin to reverse. And, a lot of that has to do with just the current environment. As insurance companies become more conservative, they start to rethink, what should our baseline be? What sort of coverages should we be offering? Are there things that perhaps we got out ahead in front of our skis on? One of those examples, which we will talk more about in this discussion, is antitrust or unfair business practices coverage. In addition to the existing scope of coverage beginning to reverse, we're also seeing new exclusions coming into the fold that have not previously been used on a wide basis. One of those exclusions, which we'll talk a little bit more about, is the communicable disease exclusion. Another, which has to do with the CARES Act, is a government funding limitation. Not necessarily an exclusion, but it's a limitation on the coverage that the D&O policy provides. And finally, with all of this going on, and this also contributes to the rates, et cetera, the less competition, many underwriters have taken a new look at the minimum cost of capital, how they deploy that capital, et cetera. And what that has resulted in is many insurance companies taking smaller positions. Or instead of writing the primary layer of a particular program, those carriers may want to sit on an excess basis going forward. And one of the things that happens in this market when so many changes are going on, and as a result, many agents are marketing their clients' programs, to everyone this year, hoping to mitigate the changes and find a better solution, is we are seeing an experience of underwriting fatigue. Because, like many businesses, insurance companies have not hired, they have not expanded their teams in order to be prepared for the influx of submissions that they're getting. So you've got the same team of people that are seeing sometimes 2 to 4 times the volume of what they're used to seeing. And what that requires is they can't get to everything. They have to pick and choose what to work on. And so obviously they're looking at that from the standpoint of industry. They're also looking at that from the standpoint of quality of submission and relationships with the people sending them those submissions. So we'll talk a little bit more about how we can differentiate ourselves and make sure that our submission or your submission gets to the top of the pile. But it's important to understand with all of these things going on, it's not simply that the insurance companies are getting more money and wanting blood. It has to do with just a confluence of things going on in the market that, are all meeting. It's kind of the perfect storm of events. The market was beginning to harden prior to COVID, and COVID hit the accelerator. So moving on, I'm going to actually let our next panelist, which is Todd Horwitz, who's the Managing Director of Arc South, talk a little bit about the impact of COVID-19 on our market.
Thank you, Brock. And thank you again, everyone, for participating with us today. So as we're on slide 6, we'll speak a little bit specifically about COVID-19 and the impact that it's had on executive risk. But Before diving into the specific impact on executive risk, whereby we have both a direct and an indirect impact in the executive risk area, we thought we'd just hit on a couple of points as respects the macro insurance industry issues. So we have a few things here. We have the fact that there are policies that intentionally respond to issues such as disease and bodily injury. And when it comes to those policies that intentionally address those issues, the insurance industry as a whole is looking at this pandemic and saying, did we really anticipate this? Even if there's no question whatsoever about whether coverage should be provided under a policy, is this something that was actuarially considered? So there is a general concern amongst insurance companies that there will be a material impact on profitability and a hit, as we've called it, to those insurance companies' reserves. Now, in addition to that, and what is very much so in the headlines these days, does not necessarily have to do with executive risk, but this issue of business interruption coverage in the event that a company could not continue to operate or continue to generate revenues as a result of COVID-19. Now, that is an entire segment. It's an entire conversation in and of itself, so we will not immerse ourselves in that. But the fact of the matter is, on top of perhaps not actuarially anticipating what a pandemic may bring for lines of coverage that would address what was intentionally to be covered there, we also have the possibility that insurance companies, either by way of the courts or by way of legislatures, may end up covering business interruption losses and arguably other losses that they are minimally saying were not anticipated. Now, if we take both of those things together and compound those with the current low interest rate environment and the fact that insurance companies' business models have for 100 years taken into account an investment income, meaningful contribution on the income statement, those bond portfolios are simply not performing the way that they do in better interest rate environments. So from a macro insurance industry standpoint, we've got insurance company executives, in some cases, overreacting, in some cases, simply redeploying capital to the greatest yield and making decisions that may or may not be the best decisions in the long run. As we turn the focus to executive risk specifically, we'll just briefly touch on really two different types of exposures that underwriters and insurance companies are having to think about, which is resulting in a shift and really a greater scrutinization of the underwriting process. So when we think about the executive risk world specifically, we do have some direct risks. For example, a company may make a certain decision regarding having employees work on-site or work off-site, or return to work or not return to work, or follow certain safety procedures or not follow certain safety procedures. If as a result of one of those decisions there is a spread of the virus, then that is a direct exposure to that management team or that board of directors that could be challenged on a cause of action basis, such as breaching their duty of care. So that's just an example of a direct exposure. However, there are a lot more indirect exposures facing the executive risk industry within the insurance realm, and that really all stems out of this economic contraction that's being experienced. Brock hit on this a few minutes ago, and as we've noted here, there is a lot of focus on a given industry. in the event that a business is in the travel or the hospitality, as well the real estate or the retail industries, notably brick and mortar retail versus online retail. Underwriters are absolutely focusing on those industries either because they have been most impacted from a financial standpoint, or there may be an increased regulatory exposure for a given industry. For example, healthcare. So industry is a real big focus these days. Financial performance equally. There are a lot of things that can come about and be a covered claim under a D&O policy in the event of adverse financial performance. We've noted a couple of things here. We can have a case where investors end up bringing actions that may have to do with things related to the business judgment rule, how the company either prepared for or didn't prepare for, or handled or didn't handle the pandemic. It can also tie into the ability of companies to be able to make their trade payables or to be able to meet their debt service. So whether claims are brought by investors, whether claims are brought by creditors or other lenders, these are exposures that underwriters are keying in on more as a result of COVID-19 than arguably before. And then also, from the standpoint of employment practices liability and workforce considerations, as a result of companies either needing to right-size the staffing size or perhaps deciding that that is just the prudent thing to do, whether it be layoffs, whether it be furloughs, whether there simply is an uptick in maybe performance-related terminations or other terminations. These are things that we have already seen lead to an uptick in claims by employees. So that is all arising out of both direct and indirect COVID-19 related exposures in executive risk. Now, Brock had started to mention this a few moments ago. What are we seeing the insurers and the underwriters starting to do from a strategy standpoint, not just be aware of these things, but how are they reacting? Brock already commented on the fact that in some cases, insurers are cutting back on their limits. In many cases, insurers are adjusting their retention levels. In most cases, insurance companies are taking up that pricing. However, when it comes to coverage, we'll spend just a few extra minutes on some of the things that we're seeing insurers do. So there's the issue of either a COVID-19, a more broad communicable disease exclusion, or sometimes insurance companies are taking a common exclusion within a D&O policy or an employment practices policy, and they are beefing it up. And we're referring there to the bodily injury exclusion that exists commonly under D&O and EPL policies. Now, clearly, this is a way for insurance companies to avoid this exposure. These exclusions have to be looked at very carefully, however, because in the event that the insurers are using a type of preamble, a type of prefacing wording when they use this exclusion that we refer to as an absolute exclusion, not a more narrow version of the exclusion, it will apply not only to those direct exposure type claims, but it can also apply to a claim that arose out of an indirect exposure. And again, if there's anything that the group would like us to drill down on during the Q&A, we can certainly do that. But we want to make sure we mention the other item that's noted here as well, which we oftentimes refer to as a government funding endorsement. while this did not happen immediately, after there was some press about fraudulent applications for PPP loans and other forms of government assistance, the D&O underwriting community relatively quickly seized on that and started to realize that there very well could be a case where either due to perhaps poor risk selection, there might be businesses within that insurer's book of business that applied for loans that never qualified for those loans in the first place. But even putting that aside, the government may end up bringing actions or requiring companies to prove up certain things that could qualify as a claim. So some insurers, just as not all insurers are imposing COVID or communicable disease exclusions, some insurers have brought forth these government funding endorsements which don't place an exclusion on that type of situation, but it limits the insurer's coverage to many times a $1 million sublimit, excess of a very large $1 million retention, might be $500,000, might be something different, but also coinsurance, many times 50% coinsurance, meaning that as respects the entirety of the covered loss, and that's once you get above the deductible, only half of that loss is going to be covered. So COVID-19, very big subject these days, wanted to make sure that we gave that its due. If you will now look at slide 7, we're going to hit on a couple of other coverage issues that are either vanguard issues or are coming back into the spotlight. One of the things that we have seen our clients experience over the past half dozen years or so at a greater frequency than the prior, at least in the prior half dozen years, are claims that could fall within the category of antitrust or unfair and deceptive business practices. Now, antitrust is a much more defined area of law. Antitrust, which is, of course, regulated by the FTC and the DOJ, antitrust is fairly well defined. What is less defined are laws, including various state laws, California being one of the most notable, are of unfair or deceptive business practices. It is not purely a list. It is more of a description. And one of the difficulties when it comes to this is that unfair business practices may apply to violations of consumer protection laws. Unfair business practices may apply to allegations of tortious interference, whether that be business relations, whether that be contractual relations. Unfair business practices may apply to false advertising or even simple misrepresentation, depending upon the context. So unfair and deceptive business practices can be a very wide berth in terms of potential claims. The concern here in the executive risk space is that the vast majority of base policy forms include such an exclusion. Now, on the positive, many of those policy forms only apply that exclusion to the entity insureds and not the insured persons, such as the directors and officers. However, some of the insurers who only have what we call entity, antitrust, and unfair business practices exclusions are broadening those to apply to all insureds, including the insured persons. Additionally, as Brock touched on earlier, there are some insurers who either by negotiation or otherwise have been willing to remove that exclusion and in essence provide this antitrust and unfair business practices coverage to all insureds. Some of those insurers are now reverting back to applying that exclusion to the entity insureds. And then we're seeing some hybrids we're seeing some situations where insurers are willing to continue providing some coverage, in some cases even affirmative coverage. However, they are imposing a sub-limit. So in the event that you have a $2 or a $5 million limit, you may only have a $1 million sub-limit for this type of loss. Or they may be applying a higher retention. Or they may be applying, as we talked about a moment ago, coinsurance. In some cases, they may be applying all three. So it is important to know how your policy, because it's such a broad topic, it's important to know how your policy addresses this type of risk, who is covered, if anyone is, for these types of claims, and are there limitations on the coverage for those parties that are covered. We'll now segue into the cyber exclusion. Up until recently, really up until, call it late 2019, early 2020, it was very rare for a D&O insurer to bring forth or certainly mandate a cyber exclusion. However, that is gaining some steam. Fortunately, the majority of the carriers have not gotten to the point where they are mandating a cyber exclusion. However, there are several insurance companies that are doing so. Once again, it's very important to understand the breadth of that cyber exclusion and who it applies to. So, for example, is it simply a case where the cyber exclusion does not apply to a data breach, or is it a case where that cyber exclusion might apply to any kind of network security event, irrespective of whether or not data was compromised? Additionally, does the exclusion only apply to the entity insureds, or does it also apply to directors and officers who very well may find themselves in a claim with allegations of breach of duty, breach of the duty of care, for example? Additionally, we really want, even if you want to be with a certain insurer who has this type of exclusion, we want to make sure, if the exclusion applies even just to the entity, that there are certain types of claims that are exempted or accepted from the exclusion. And the reason for this is because even though we would advise the vast majority of our clients to have a separate cyber insurance policy, to have an insurance program that addresses that type of risk, there are going to be some cyber-related claims that aren't addressed by that type of program, including a claim brought by investors related to the company's securities. A securities-related claim is not going to find coverage under a cyber program. And so these exemptions to the exclusion need to be negotiated if not already present. So we're now going to hit on what is oftentimes referred to as the BIPA exclusion, and I will hand things back over to Brock for that.
Thanks, Todd. So just briefly here on this biometric exclusion, this relates to the Illinois law that was passed in 2008. It went kind of largely unnoticed for half a decade. When in 2015 there was a series of class action lawsuits brought against businesses for unlawful collection of biometric information, whether that's on employees, whether that's on customers. And when we talk about biometrics, we're talking about fingerprints, retinal scans, things of that nature. And the Illinois law, which was at the time unique, but has now since been followed by many states, including Washington and Texas, it requires things like informed consent prior to collecting that information. It permits a limited right of disclosure. It prohibits profiting from someone's biometric data. And it includes penalties and statutory damages up to $1,000 for each violation, or up to $5,000 if that violation is deemed to be intentional or reckless. It's all, the devil is in the details in terms of how these exclusions are composed, but you can imagine that with D&O, with employment practices, there are issues at hand such as, was there a failure to manage by management that ended up causing this initial issue? Were you collecting employee data and storing it for security systems or health and welfare plans, things of that nature. So just very important that this exclusion not be misused. We oftentimes are able to get it negotiated off of insurer proposals, but if this exclusion is, exists on your policy today, it's something you need to think about and talk about with your insurance professional. So now we're going to look at some of the claims involved with COVID and just in the market in general. And for that, I'm going to turn it over to Heather.
Thanks, Brock. Great to be with everyone today. I thought, and I'm sure most people on this call are aware, the most frequent claim against private companies are employment claims. And so I thought it would be a good place to start. Roughly 70% of all claims against private companies are employment in nature. And given the times we're residing in, I thought we could start by taking a look at the COVID-19 impact on employment claims. Todd touched a little bit on this earlier. Jackson Lewis has a very cool tracking system on their website. If you're interested, you can check it out. They have a whole bunch of different tools and charts. I took some of the ones that I thought was interesting here. As everyone knows, earlier this year, with quickly evolving legislation, unprecedented public directives, employers had to make very quick decisions. And I'm general counsel here at ARC, so I'm well aware of how difficult and time pressured those decisions were. And so it's no surprise that from March 12th to September 10th, this chart shows that we had 657 COVID-related claims that were filed in state and federal court. And Jackson Lewis is tracking those, the word COVID, but then they look at the cases to see if they're really COVID-related. But we'll no doubt see a rapid increase in those numbers because, as you may know, the EEOC had suspended issuing right to sue letters in March, and then they just started issuing them again, the ones that were held in abeyance in early August, and they've been releasing them little by little over the last couple of weeks. Insurance carriers, and I've spoken with the top of the claims groups, they're well aware and they're already seeing an influx of these cases, and they're dedicating teams to handling these cases specifically. When you look at the types of claims being filed, not surprisingly, disability represents roughly 40% of the cases. You may know the ADA requires, that's the Americans with Disabilities Act, requires employers of 15 or more to make an accommodation if it's reasonable and if it doesn't cause undue hardship on the employer. The interesting thing, as employers are starting to bring their employees back to work, particularly office workforce that were able to work from home, where people are asking for accommodations, employers have a tough decision to make if they really want to make people come back into the office, because people were working from home and assuming it was going well, it doesn't seem, that you're going to find that to be an undue hardship for people to continue to work at home. So that makes, difficult decision-making again for employers. Another thing I'll just reference for you, if you're looking for, more information on best practices in this area, the EEOC website has a ton of frequently asked questions that I've used many times that gives a lot of information about what you can do in terms of testing employees and asking employees for information, et cetera, in this area. The number 2 claim you see is retaliation. We expect we'll continue to see a trend in these cases, and Todd mentioned this earlier. We've seen cases in retail stores where employees complained they were getting inadequate PPE, and then some adverse employment action was taken against them, purportedly as a result of their complaint. I saw another one in a funeral home where a funeral director was trying to follow the public directive against large gatherings and enforce that in a difficult circumstance in a funeral, and alleges that she was terminated in retaliation for trying to follow the law. And as you can imagine, the list goes on in this area. Retaliation claims generally are very challenging to defend. When you think about it, the burden for the plaintiff is to show that they took some protective activity and then that an adverse employment action happened thereafter, and was connected, of course. But they don't ever have to show that the complaint they made was accurate. So in the instant that I just gave, if you complain you weren't getting enough PPE, whether or not you were getting enough PPE, if you're subsequently demoted or moved somewhere else to a different job, you have a pretty good case there, even if it's not accurate, to say, I made the complaint and then this action happened. And so those cases are very costly and challenging for employers. The other thing I want to just quickly note on this chart, if you look at the map, it'll show you what we typically see in employment cases, which is California leads the pack, New Jersey, Texas, Florida, New York. Just like we see in normal employment cases, we're seeing, the hot spots be the same here related to COVID. Brock, if we could go to the next slide, please. The next area that I get a lot of questions on is, how has the Me Too movement impacted employment claims? And I will tell you, we are definitely seeing that plaintiffs have been emboldened. And again, claims departments confirm that to me, and I see it in the cases that I handle. In my role at ARC, I work with our clients to help them liaise with the insurance carriers to get their cases settled. And, not only is it the emboldened plaintiffs, you also have these plaintiff lawyers who are setting unrealistic expectations, sort of fanning the flames and making the cases even more difficult to settle. The cases against the C-suite really, of course, are the worst because you have a high profile situation. And, there's the threat there of the publicity that could be garnered from the plaintiff or the plaintiff's lawyer going to the press. I just settled one recently. I don't say I didn't settle it. I was involved in the settlement of it. It was a mid-sized financial firm where the CEO was alleged to have said some pretty salacious things to an employee, female employee. The female employee was earning $100,000 a year. The case settled pretty quickly, like within 6 months at a mediation, really after the mediation, but it was mediated first. And the case settled for $1 million. Now, the reason that's alarming and striking is because typically these cases would settle Me Too movement 2 to 3 times salary, which would have been $200,000 to $300,000. Now we're looking at $1 million figure. The reason for that, of course, and becomes a coverage issue, is the client does, they're having problems with their investors because this particular plaintiff went to the press already, and they wanted the case to go away and not hit the press again. And so they ended up paying, what I see as an exorbitant, and they did as well, settlement and, get in exchange a release and not have more publicity out of it. Now, the coverage issue is that the carriers will say, we see this as a $200,000 to $300,000 case. You're paying extra for your, to avoid the bad press. That's a business decision, and we don't cover that under the policy. And that's where brokers and the claims department at brokers can be helpful to you in, as I said, I liaise to try and help this case on the allocation, what contribution, the insured had to put a contribution in, but what contribution is appropriate in the circumstances, and we can help you through that. The next sort of interesting thing that I see is this so-called reverse Me Too phenomena. I have a case in the office, first, when the Me Too movement happened, experts went out of their way to say, do not overreact. If you get a sexual harassment claim, properly investigate it, take the proper steps, do it swiftly, all of those things, but don't overreact against the harasser. In the case that I have in the office, it's a very large, again, financial firm. It was a significant wage earner, the male employee who was alleged to do the harassing. The allegations were that his assistant said that he was hiring a new assistant, she was leaving, and he said, I hope, the next assistant I get, I'll be able to say inappropriate things. And he said those inappropriate things to this person with other female employees listening. The female employees complained to HR and said, he said these horrible things. There was a swift investigation. the company decided to terminate this individual. Again, he was a managing director making, a lot of money. They were trying to negotiate a package for this person to leave. The deal fell apart. The male managing director left, went to the press and said, they overreacted. I didn't do anything worse than anybody else. And, this is a problem in this Me Too era where, the males are not getting a fair shake, essentially. And so the case that ended up getting filed is now, in response to that, the employer put out a press release trying to, mitigate things, but ultimately they ended up getting a lawsuit that they defamed this person, they wrongfully terminated this person, and the demand, because again, he's a very significant wage earner, is $100 million, $100 million. And so there's a crop of plaintiff lawyers that are looking at these cases. Of course, the practice tip we all know is, as I started out by saying, do your investigation, do it swiftly, deliver consistent discipline. That doesn't mean you may not see a case, but at least you've, put up a good defense for yourself. But I think this case also illustrates, you're sort of damned if you do, damned if you don't. If you didn't do what they did here, they may have had complaints internally from the female employees saying, you're not taking action. We've told you that there's sexual harassment occurring. All right, and if we can go to the next slide. Thank you, Brock. In the D&O realm, I didn't put it on the slide, but of course there are bankruptcy cases are some of the more severe cases that we see. I have one now, it's against a college where the college is alleged by the trustee in bankruptcy to have taken a whole bunch of actions that ultimately, the trustee argues caused the college to close their door. So basically breach of fiduciary duty. And those cases, again, very expensive, both in terms of defense and indemnity. And the problem with those cases too is there's a lot of investigation that goes on before it becomes an actual capital C claim under the policy triggering the defense under the policy. And so there's a lot of out-of-pocket costs that can happen before that, before you get to the actual claim. The other thing, and this was mentioned earlier, that we see are a lot of consumer class action cases. Again, you got to look carefully at the policy to see if there's coverage. The first one, the unfair trade practices cases, I had one in the office. It was a large retail chain. They had some outlet stores. At the outlet, if you shop at the outlets, you often see these tags on the goods that say your price is, $9.99. Their price would be $25.99. And so the case was you deceptively, tried to lure consumers into thinking they were getting a great bargain. We reported that claim to the carrier. The carrier initially declined the case actually and said there wasn't an unfair trade practices exclusion in the policy, but they said that the E&O, the errors and omissions exclusion applied because when you price your goods, that's the service to your consumer. We at the brokerage, sort of laughed at that and said that's ludicrous. We fought pretty hard actually to get the carrier to reverse their position because again, as Brock mentioned, these policies, D&O policies were not initially thought of, we're going to go out as underwriters and cover consumer class actions. They more thought they were going to cover, D&O claims against the board, but the policies are written so broadly that they cover these claims, and sometimes carriers can out of the box try to avoid them by taking interesting, I'll call it interesting positions. And so that case, again, once we reversed the position, millions of dollars in defense, millions of dollars in really plaintiff's fees more than indemnity that went back to any consumer. All right, the next case is the unfair business practices, false advertising cases. These, we've seen a large amount of them against food manufacturers. In this area, there's, again, a crop of class action lawyers focused on food manufacturers. They're looking at the labeling and they see words like natural and pure, and they file a class action saying your product, really isn't that. It's misleading that you're calling it that. Give you an idea of the focus in this area, approximately 20 cases were filed in 2008. And then in 2015 to 2016, in that 2-year frame, we saw 425 active cases in this area. Again, California is the most popular site for these cases, with New York in the second. In the office, I have seen one against an olive oil producer that advertised their olive oil was extra virgin. I had another one against a sugar company where they were arguing that their sugar was pure, and the plaintiff's bar came against both of those companies. And the final one I have on this slide, a lot of times people think that shareholder claims are only made against public companies. That's really not the case. We see them against private companies with, fairly severe consequences. I put these are two pretty high profile cases that I put down, but we definitely see them against smaller, less well-known clients as well. I'll give you just a quick explanation on the facts in these cases. The Juul Labs case, Juul Labs, you may know, is a maker and marketer of electronic cigarettes and vaping products. Altria, a tobacco company, made an investment in them to the tune of $12.8 billion. And that implied a valuation of Juul at $38 billion. Thereafter, and you may have read about these, there were multiple regulatory investigations, one for marketing the products to children, another for marketing the products as a safe alternative to tobacco, and then another for people who were getting ill for the negative health effects. As a result of that, Altria wrote down its investment from the $38 billion to $24 billion, and shareholders then brought suit both directly as a direct shareholder action and then derivatively on behalf of the company against the board. And they allege breaches of fiduciary duty by the board that caused those regulatory actions, as well as they said the board engaged in self-dealing because they issued a special dividend to themselves and not to the minority shareholders. The other case I list here is the WeWork case. They had similar, allegations situation. Their unfair dealing allegations related to the CEO purportedly using related party transactions to, benefit himself. But that case is also an example of a failure to launch an IPO. And we do see those cases. They're not, I wouldn't say terribly frequently, but we do see those cases, and I have seen them in the course of my career. Brings up another important coverage point. All of the private company policies are going to have a public company exclusion on it, an exclusion that will apply if you go public, but there should always be an exception to that exclusion for the roadshow or preparations to go public, so that in a case like this, where you ultimately tried to go public and had a problem, that when the private company shareholders sue you, that you have coverage for that claim. At this point, I will turn the conversation back to Brock. Hopefully, if folks have some questions, we'd be more than happy to take them. At this point, Brock is going to talk to us about important tips for renewing your program in these challenging times.
Sure. Thanks, Heather. So just real briefly, so that we've got a couple minutes for questions, just some things to consider. Keep in mind, we are in an environment right now where underwriters have more on their plate than they have time for. And, they are very pessimistic about taking on new accounts, as well as looking at their renewal book and making sure that their existing clients are going to survive, not going to, get sued, et cetera. So just some things to think about. Timing's critical. Got to get started early. Bad news is coming fairly regularly right now. And if you don't have enough time to pivot and look for other options, insurance companies, at least some of them, are not offering extensions to give you more time. So timing, getting started, getting that information in the underwriter's hands early, at least 30 days, is critical. In addition to that, it's the quality of information that you're submitting. You want to go out of your way to try and put together, similar to the way you would a proposal to your lender or a proposal to your shareholders. I'm not talking about a PowerPoint, but you want to put together a very consolidated yet concise, clear, positive message to that underwriter. Make sure that you're giving them the information that they're asking for, that information is clear, that if there's a question that warrants more information, such as you had to answer yes on, hey, we've got this incident going on, or we're planning a transaction, give them that additional information that gets them comfortable, versus having them ask for it. It just, we've got to look at this as we are proposing to the underwriter, in order to either continue a relationship or create a new one. And then we also need to anticipate some of their concerns. If the financial situation right now is tough, then we need to lay out how it's going to get better. All right. If we've got some debt coming due, we need to talk about the discussions we're having with lenders today, or what our plans are to address that debt. If we've had to, lay off some employees, put some people on furlough, then we need to talk about how we went through choosing who got laid off versus who went on furlough, and how we're bringing those employees back. Did we engage outside counsel, et cetera? And then finally, have there been changes to management? Have there been changes to the board? If so, why? Just because really underwriters are looking for whether disagreements, et cetera. So we just want to give those underwriters the information they need so that we're not raising red flags. We're addressing, questions and issues and concerns early, and kind of keeping them focused on continuing that relationship with a reasonable renewal quote, or creating a new relationship with aggressive terms. So I'm going to turn it back over to Bill to close us out and to address any questions.
Brock, thank you so much, and thank you to Todd, Heather, and again, Brock, and all of the work you've done here from ARC. On behalf of Farmer K, we appreciate it. We feel that this content is extremely timely and of great concern to most of our middle market clients. I especially appreciate some of the claim scenarios that you brought up, Heather. Unfortunately, a number of our clients are facing them as we speak. And Todd and Brock, thank you for some of your strategies, making our clients aware of some of the headwinds that are being faced right now in the executive risk, and some strategies for giving them a best-in-class submission. At this time, I'm happy to turn it over to any questions from the audience. Feel free to enter a question in the chat box. While you all are considering that, I will also mention for any of you that have follow-up questions at the conclusion of this, feel free to get in touch with your relationship manager or client advisor, whoever invited you to this webinar on behalf of Palmer & K. We are happy to have some more one-on-one conversations with you.
Yeah, and I'll address one question that came in. The question was, what happens if we're collecting biometric information on customers, but we're not storing that information, or in the event that we choose to use a third party to even collect that biometric information, what does that mean for our exposure? And the answer is similar with other personal data. Again, going back to those biometric exclusions or acts in Illinois and other states, with other personal data, if you're collecting that personal data, if it is your customers, whether that data is sitting on your servers or whether you have given access to that data to a third party in order to collect that data on your behalf and or store it or analyze it, please keep in mind that you need to be talking to those vendors. You need to be talking to those customers to make sure, to those third parties, to ensure that you are, allowed to have that data, allowed to store that data, and that data is stored safely. That is very, very important. You can, you can be held liable even though you've got a third party that is actually collecting and holding that information. You can still be named in that lawsuit and have liability associated with that.
And I see we have a question.
And Heather,
sorry.
Yeah, you want to take that?
Sure, happy to. So frequency and severity, I have not seen statistics that compare private to public. I can tell you as a general matter, and when I was at AIG and chief underwriting officer there, we looked at that carefully, and public companies always had a higher both frequency and severity. The public, somewhat because of the name brand aspect. I would suspect right now, because of the layoffs, in the public market with companies watching, their earnings, there's probably more in the public market, but that's really just my, my suspicion. I have not seen any data on that.
So I have a question that came in from a client by text message, and the question is, with respect to unfair business practices and false advertising, what are some steps that businesses can take to protect themselves in the event that that a suit is brought against them, that if they've done these 3 things or 5 things, that it puts them in a better position for their carrier to defend them?
Is that specific to the claim scenario on the products or just unfair business practices?
I think it's unfair business practices in general. I mean, this particular client that sent the text happens to be a consumer products manufacturer, but they weren't any more specific than that.
Okay. All right. I mean, of course, you know, having competent legal counsel review, you know, the marketing materials and the, you know, the product, you know, assertions is probably the most important. You know, to some degree, and you know, I hate to be this cynical, but having done what I do for so long, I am. You know, you can do all of those things and still, of course, suffer the litigation, and that's why these policies, if we can, you know, maintain the coverage, to have that defense there is critically important, because you can do all the things right and still get sued by these lawyers. I don't know, Todd, if you have anything to add outside of that. You know, having it reviewed legally would be the prime.
I do agree with that. I think that it's almost such a broad scope question that it's difficult to put one answer to it, because as we talked about before, unfair business practices in and of itself has so many subcomponents. You know, when it comes to, for example, the tortious interference allegation, that we've had a number of clients with claims in that area, a lot of times those claims have come up because of somebody that they hired from a competitor. And, you know, so on that subject, there are certainly things that can be done ahead of hiring, you know, someone in a sales or business development or other key position from a competitor. There are things that can be done ahead of time, which I won't just list off right now, that can, you know, maybe not insulate, but certainly help alleviate liability down the road. So it's a very wide field.
Well, again, this is Bill from Palmer & Kay. I want to respect everybody's time. We're a little bit past the top of the hour. Those are some great questions. Again, Brock, Todd, and Heather, we really appreciate your time today. Thank you so much for the rich content. And we look forward to hosting some of the participants on this call at a future Palmer & Kay webinar. Keep on the lookout for October and November releases coming shortly. So again, thank you so much, and everyone have a wonderful day.